Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome to the audio version of the Runway Report Newsletter. This edition is covering the month of December 2025 and will be the last edition for 2025. So without further ado, let's get into the December 2025 edition. So as always, just starting off with a note from myself as the director, I really want to sincerely thank all of our clients and subscribers for their continued support throughout the year. Working with Australians both at home and abroad certainly remains at the core of what we do, and we really appreciate the trust you place in us in helping us manage your financial planning needs. I did just want to raise our trading hours for the upcoming Christmas New Year period. So we'll be closing from Friday, the 19th of December, reopening on Monday, the 5th of January, 2026. During this time, we'll still be monitoring emails periodically and we'll respond to urgent requests as promptly as possible. But on behalf of the team, really want to wish you and your families a relaxing and wonderful Christmas period and New Year break. And we look forward to returning refreshed in 2026, ready to continue supporting you all with your financial planning needs, wherever in the world you may be. Before we sign off on the note from the director, I'm also excited to share our latest podcast episode is out. So in this episode, we recap the major market events of 2025 and discuss what investors may expect in 2026. And this can be accessed via YouTube or through your preferred streaming platform, whether that be Spotify or Apple Podcasts. The Expat Insight for this month is touching on the changes that have come out of Australia, released by APRA, which is the banking regulator in Australia. So on the 27th of November, the Australian Prudential Regulation Authority, which is APRA, announced a new limit on high debt to income home loans. And this is to curb riskier borrowing and reduce the chance of financial vulnerabilities kind of building up in the Australian housing market at the moment. So essentially what this means, these rules will look to come into effect from 1 February 2026, and banks will, from that date, be restricted from writing no more than 20% of their loan books to borrowers at a debt to income ratio of 6 times or higher. So this will be a cap for both home loans and investor loans. Principal place of residence loans and then investor loans. So there'll be a 20% limit for banks for each of those kinds of loans. So this is probably best explained with an example. So for example, if you're earning in Australian dollars 150,000, you look to take on a loan, you're looking for finance of $1 million. So essentially this would result in a debt to income of 6.7. So we've exceeded the limit of 6 there. And this is calculated by the loan amount that you're seeking divided by your income. So if you do $1 million divided by 150,000, you get 6.7. So if that's the case, it's not saying that you won't get finance, but a lender may be less willing to approve that loan if they as a bank are approaching that 20% cap on investor loans or home loans. So you may, in that instance, you may need to just demonstrate some stronger income evidence, maybe increase your deposit or even consider a slightly smaller purchase price. So this has all come about. So APRA has said in their announcement that lending standards still remain generally sound in Australia, but recent trends such as lower interest rates, rising property prices, and increased investor activity point to early signs of riskier borrowing behavior starting to take place. So high DTI loans, especially among investors, have begun to climb from a relatively low base. So these caps of 20% are intended as just guardrails to prevent excessive household indebtedness and protect financial stability before these risks kind of play out. So for most borrowers, the limits won't immediately reduce access to credit, as the current lending environment is, as I said, banks aren't kind of exceeding that 20% limit just yet, but some banks are close to that limit, particularly for investor lending. So that may tighten their criteria in the future. Now, how this kind of takes or applies to Australian expats. So for those, considering buying an investment property from abroad, or even just planning a home purchase ahead of returning to Australia, these changes could influence your borrowing capacity. So expats already face, some additional assessment criteria due to their overseas jurisdiction, due to earning income overseas. So this new constraint may add another layer of scrutiny. So if you're planning to purchase on your return to Australia, it may be worthwhile to start discussing borrowing capacity early. So speak to a mortgage broker about your current borrowing capacity. Expat income assessments vary between different lenders. So the new DTI, debt to income cap, may narrow the pool of banks willing to lend to Australian expats. So if you're thinking of about entering the property market in the short term, reviewing your borrowing plans, particularly your DTI position, will help you stay ahead of those tighter credit conditions into 2026. As we move into the market movement section, so if we just touch on the Australian market, Australian shares disappointed in November as higher inflation data ruled out the prospect of further interest rate cuts in 2025. The benchmark ASX 200 index fell 3% in the month of November. Movements in global shares were relatively muted. The outperformer was the Indian stock market. So Indian shares outperformed, they rose 1.87%. And then if we kind of dive into the Australian share market in a little bit more detail. So Australian shares fell in November, as I said, by 3%, mostly just due to the rise in consumer inflation data that we got more recently. So that kind of dashed hopes for interest rate cuts in the short to medium term. The IT, so the technology sector, was the hardest hit. It dropped about 11% amid the volatility in the US market as well. The financial sector also struggled. It lost 6.5%. So these are more interest rate sensitive sectors of the Australian market. We did have consumer discretionary and real estate shares also just declined as expectations for lower interest rates faded. So again, those are two other sectors that are affected by higher or lower interest rates. We had some more defensive sectors such as the healthcare and consumer staples posted solid gains through November as investors turned a little bit more cautious in light of that interest rate outlook. Again, the resources sector held up quite well, supported by strong increases in gold and base metal prices. Copper has been doing incredibly well more recently as well. As we turn to global shares, so they ended a relatively turbulent November with relatively flat returns. As I said, it was pretty muted among global shares. Concerns over expensive share valuations were countered by hopes for lower US interest rates in December. So we had US share prices had a roller coaster ride in November. Notably, the technology companies, Amazon, Meta, Microsoft, recorded some sharp price falls in early December as concerns over higher valuations really cautioned investors. We also had some slower retail spending data come out of the United States, but that kind of helped share prices because it boosted hopes for the US Fed to cut interest rates at its December meeting. Just touching on Chinese shares. So Chinese shares fell as China's slow retail sales and weak property market really remain key concerns for investors in those markets. A bit of a calendar year to date wrap up. So if we reflect on the performance of Australian and global shares through 2025 to date, so up until the 9th of December, I've done this analysis too. So we can see each of the shares, share markets that we've covered in this newsletter throughout the year have all ended the year, well, as at 9 December, in positive territory, and expected to remain at those levels as we kind of close out 2025. So just exceptional gains across the board there. The only exception is Bitcoin, which has come off a little bit more recently. But broadly, the share markets, particularly Asian share markets, have really outperformed through 2025. So what drove the performance of shares in 2025? So we had really strong optimism for generative AI and lower interest rates globally. So those were the key drivers for rising share prices in 2025. Investors have also taken the view that President Trump's tariffs are a more temporary threat to higher inflation and economic growth. So they've kind of looked through that. In the medium term, it was just in the Australian dollar really strengthened considerably against the US dollar in 2025. So that's really reflecting growing concerns about the US economic situation, and particularly the trade policies coming out of Washington. As I said earlier, Asian share markets have posted really strong gains in calendar year 2025. In China, we've seen some increased government support aimed at really offsetting the effect of the US tariffs and a weak property sector. So that's helped drive a really solid rebound in share prices. Japan's market has been another standout. So that's been supported by its central bank being a bit slower to lift interest rates. They do have some rising inflation concerns there, but they haven't looked to lift rates and don't look to be lifting interest rates in the near term. Throughout 2025, so that has kind of supported the Japanese share market, represented by the Nikkei 225 is the index there. Australian shares, unfortunately, have lagged behind global markets in 2025, mostly due to the fading expectations for interest rate cuts. That's weighed on share prices in the last couple of months. So I think as of 2 or 3 months ago, markets peaked. So we were a little bit higher, but have come off 2 or 3% since the peak there. Rounding this out with an economic update. So just touching on the Australian economy first. So we had a major development in Australia during November was the release of this fully detailed monthly consumer price index report. So this covered the month of October. So before November, the Reserve Bank and economists were relying on quarterly inflation updates, which are a little bit outdated. But most advanced economies have a monthly consumer price index report. So it's good that Australia now has one. So in that data, it showed that inflation pressures really remain stubborn here in Australia. So annual inflation rose to 3.8% in October, up from 3.6% the month before in September, but well above the mid-year low of 2.1%, which we saw in June. So you can see Australia's inflation has really picked up. Core inflation, which is otherwise known as the trimmed mean CPI, this is what the Reserve Bank is mostly focused on. So that came in higher than expected. It came in at 3.3% in the 12 months to October, up from 3.2% in September. Now, because these figures, each sit above the Reserve Bank's target band of 2 to 3%, the chances of further interest rate cuts have really diminished more recently. We've also got stronger labour market conditions, kind of adding to that pressure. So with the unemployment rate dropping from 4.5 to 4.3% in October, there's not a lot of supportive data that supports the decision for interest rate cuts in the medium term. We did see some quarterly economic data out of Australia. So the gross domestic product report, so it showed that the Australian economy grew by 0.4% in the September quarter, and over the 12 months to September, it increased 2.1%. Now, this was a little bit weaker than expected, but much of the softness in that number came from businesses reducing their inventories. Underlying domestic demand was still solid. Consumers, businesses, and governments are still all contributed to growth in that quarterly GDP report. Touching on the global economy, so in November, the US government shutdown finally came to an end after lawmakers in Washington reached a deal to reopen federal operations. So the compromise that they came to did not resolve a long-running kind of issue over healthcare insurance subsidies, but it did allow essential services to resume. So the agreement moved pretty quickly through the Senate and the House before being signed by President Trump. So that kind of created a wave of reassuring headlines in the US. Another notable event development in the US was the long-delayed release of the September US payrolls data. So because the government was in shutdown, we didn't have a lot of data coming out through that period. So this is kind of delayed from September. Now, that report showed a mixed picture. So job growth in the United States came in stronger than expected. There are 119,000 jobs added, but the unemployment rate did rise to 4.4%. So markets were left a little bit unsure how the Federal Reserve would interpret that combination of signals. Heading into December, so ahead of the Federal Reserve's December meeting, where we had Governor Christopher Wallace express support for an interest rate cut in December. So these are US central bankers. Wallace's comments were followed similarly by remarks from the New York Fed President, John Williams. So they were supporting an interest rate cut at the December meeting. So heading into the meeting, investors were ascribing about a 90% chance that the US Fed would cut interest rates by 0.25%. As we now know, as of the 11th of December, the Fed did in fact proceed with that interest rate cut of 0.25%. That's all for the December edition of the Runway Report. I really want to thank you for tuning into the newsletter, subscribing to the newsletter throughout 2025. We look forward to returning in 2026 with fresh, exciting updates to keep you informed and on track with your financial journey. So thanks for tuning in. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.